Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing British American Tobacco stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. British American Tobacco is a British company that manufactures and sells cigarettes, tobacco, and other nicotine products. The company was established in 1902 and is headquartered in London, England. It is the largest tobacco company in the world based on sales. It has operations in 180 countries. Its cigarette brands include Dunhill, Kent, Lucky Strike, Pall Mall, and Rothmans. Its brands also include the following vaporizers: Vipe, Vuse, and Glow. Let's get started with the model. This is a large cap company, 86 billion market cap. They're trading at $38 a share, and they have 2.3 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has lots of free cash flow every year. 6 billion up to 13 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they had a massive net income in 2017 at 51 billion, but it's around $7 or $8 billion a year after that. Revenue is the sales for the company, and that grew a lot from 28 billion to 36 billion. This is the company's income statement. All their numbers are in British pounds. I converted these numbers to US dollars on my Excel sheet. So right now we're looking at pounds. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference is the gross profit. And that peaked in the trailing 12 months at 21.6 billion. It was pretty similar in 2019 at 21.4 billion, but much higher than 2018 and 2017. Below that is operating expenses. Then below that is operating income. So you can see the company generates lots of operating income. It was the lowest in 2017 at 6 billion, but it peaked at 9.4 billion in the trailing 12 months. The company pays 1.7 billion pounds of interest on their debt. The reason the company had so much net income in 2017 was from the gains on the acquisition of Reynolds American. This is accounting gains and it doesn't affect cash flow. When I look at a company, I would focus on their operating income when I look at the income statement and the statement of cash flows, because below operating income can really skew the numbers. But please leave a comment if you want more color on this particular topic. So the bottom line of the income statement is their net income, and you can see the company has lots of net income each year. This is the company statement of cash flows. The top line is operating cash flow. In 2017, they generated 5 billion of operating cash flow. The main reason was their sales were much lower in 2017. That huge net income amount doesn't affect cash flow, as you can see. The company spends around 700 million to 1 billion pounds in capex each year. Capex are investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow. And they have lots of free cash flow each year. It did peak in the trailing 12 months. So the company is doing better than ever in 2020. 10 billion pounds of free cash flow, that's a lot of money to work with. They could pay a dividend with that money, buy back stock, pay down debt, or reinvest back into their business to grow it. You can see the company issued 40 billion of debt in 2017. The company issued this much debt probably to acquire another company or to acquire multiple companies. After 2017, it looks like they're paying down more debt than they're issuing each year. Let's look at a capital structure. $88 billion of equity, $62 billion of debt. They're 59% equity, 41% debt. And their WACC is 8%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 263 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $236 billion. We divide that by 2.3 billion shares, and we get a calculated stock price of 103. They're trading at 38, so they're trading at a 63% discount. It's a really strong buy according to the model. Simply Wall Street values the company at $79, so they're also saying it's undervalued. It looks like the stock did peak around $70 a few years ago, but has been coming down. I'm not sure why, because the company's still generating lots of free cash flow. So it looks like it's sitting at a really great value. This company pays an amazing dividend, 7.2%, and they pay out 71% of their net income, 48% of their free cash flow. So they're a pretty generous company when it comes to dividend payments. They have a low beta, 0.59, so the stock moves about half the market. The stock has gone down 13% in the past 52 weeks, much worse than the S&P 500. The low was 27, the high was 45. The stock is trading above its 200-day moving average, but below its 50-day moving average. About 1.5 to 2 million shares are traded each day for this stock. Most of the shares outstanding are on float, and only 6% of the shares are held by institutions, and has a really low short percentage, 10 basis points. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $16,500 today. If you did not reinvest the dividends, you'd have pretty much the same amount today. If you did buy $10,000 of this stock 10 years ago, you could have sold at about $25,000 at its peak. But if you're still holding on, you're at $16,500, a 5% annual return. Capital Research owns 12.5% of the stock, then BlackRock at 7.5%, then Spring Mountain, Vanguard, and then another company owns 2.6% of the stock. Let's look at the financial ratios. The average PE in the market's 11.5, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a 10 PE, which is better than the median and average. That means investors are paying $10 for $1 of earnings. Price to sales is stock price over sales per share. They're at 2.4, also better than the median and average. Price to book is stock price over book value per share. They're at 1.0. That's a really good price to book. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $88 billion. Tangible equity is negative $75 billion because they have a lot of intangible assets on their balance sheet. 44 billion pounds of goodwill and 75 billion pounds of other. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments 5 times. ROE is net income over equity. They're at 10%. Current ratio is current assets over current liabilities. They can cover 70% of their current liabilities with their current assets. And their current assets are $2 billion of cash, $6 billion of inventory, and $640 million of restricted cash. So it does not look like the company is that well funded. They did have positive $13 billion of free cash flow, but negative $7.6 billion of working capital. They also have a $6 billion dividend payment. So they're at negative $867 million according to my calculation. The best way to look at ratios is to compare them to similar companies. The only other company in the tobacco industry that I did was Altria Group. And British American Tobacco has a better PE, price to sales, price to book, and current ratio, although it's under 1. They're both pretty similar in ROE. British is much better in debt at only 41%, half of Altria. They're both really big companies, 86 billion and 77 billion market cap, and both pay amazing dividends, 7.2 and 8.2%. So to summarize, I do have them trading at a 63% discount. I rank their free cash flows 9 out of 10. $13 billion is a lot of money. Plus it went up 15% from last year. Their revenue I rank 8 out of 10. $36 billion is a lot of revenue, but it's flat from last year. The ratio is 7 out of 10 because they have a low current ratio and not such a great ROE. I rank their products and brand an 8 because they're pretty well known. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.